Okay, welcome. A few minutes late to the weekly live stream, weekly roundup live stream, Hart Investment Group. I'm Scott, that's Ben.
Hello.
And it is, April 19th. It was a busy week.
Yes.
But you know what may have the biggest effect on the economy? That dropped today, Taylor Swift's new album.
Yeah, seems like everyone's excited about that.
I know. Well, definitely the younger generations for sure.
I thought you were going to say that the biggest effect on the Ottawa economy dropped this week.
Oh, that's another thing too. With Ironman Ottawa announced for August 2025.
That's it.
Two
Exciting.
wily veteran finishers here. You finishing Ironman Tremblant in what year? Not that long ago.
2019.
19.
Yeah.
Yeah. And me finishing Ironman Hawaii in 2003. That's over 20 years ago. That's crazy. Yeah. And by the looks of us, you could probably see who was closer to the finish than me between the two of us. So anyway, those two exciting things happened this week. But what else material happened this week in the real economy?
The real economy, we're getting a reasonable correction into the growthier things here. We had the investment manager in this week that we had some interesting discussions about just around what's going on with the economy. But first kind of real correction that we're seeing in bigger kind of growthier things. Effectively, you can say that it's the yields have creeped up. So we got to kind of 4.5 or so, 4.6 on the US 10-year bond, that is, tends to put pressure on the markets and growth and things like that. So exciting from the perspective of this presents opportunity. So if you got cash, we've been looking at it here as I see some of these things like NVIDIA down 10% today. We don't own NVIDIA, but down 10% today. But even some of the bigger ones like Amazon, Microsoft, Amazon down 3%. So some of the growthier stuff that doesn't like higher rates is starting to see an impact here. Not material, but I mean, you probably read the headlines and it'll be probably top story. Some of the headlines are saying Israel, Iran heating up. We'll see. But I think it's mostly as a result of interest rates kind of creeping higher. And we get in Canada and the US, we get really diverging central bank policy, which we'll talk about a little bit but when we go through the slides. But yeah, quite a few things going on from a market perspective. And I think geopolitical is taking a lot more interest than I've seen in probably 15 years.
Yeah, seems like it for sure.
Yeah.
All right. What do you got a nice slide deck set up for us there?
Try to keep it into a positive slide deck. I used some of GMI slides today, so that'll take it with a slightly more positive tone. But let me just let me know when you can see it.
Yep, looks good.
Looks good. All right. Just got to get them in front of me here. All right, so this is certainly I'll just give an update on interest rates, and then we'll talk a little bit more about the charts and what they look like. But with the presentation that I said we had this week, a big bond manager manages a few $1 billion in Canada, mostly institutional tilt, really flagged this and pointed this out. And so I just wanted to hit on a little bit. But if we look at where rates are, and rates are expected to be in Canada, so right now we are at 5% on the overnight rate in Canada, and the US is at 5.5%. And presently, right now, the bond market's already priced in a little bit of a discount to what the market's presently at. So right now we're at a 0.5% below the US Fed. If you look at these numbers here, they're projecting that kind of a 50-50 coin toss. I think this will continue to move towards this, where the Canadian central bank has to cut rates because our economy is slowing faster than the U.S. economy. But the challenge becomes when that spread continues to widen. So we've seen this last little while, probably about a 5% move, which is the Canadian dollar weakening versus the US. And it's really been this divergence. So part of it's economy, part of it's what the rates are doing. And so, we enter this period where there's 0.5% spread right now. How far can the central bank in Canada move from the US central bank from a rate perspective? And I think the answer lies somewhere from looking back at our past a bit, where we saw the widest we've ever been is 225 from the US. We were 225 basis points, or 2.25% lower than the US central bank in 98. And that resulted in a pretty weak currency and a bit of a currency crisis. And we needed some intervention. So don't know that we're going to see this, but we definitely have diverging economies and diverging central bank policies, which will be important to watch as things progress here. And ECB, as you probably see, I've referenced, it's almost a certainty that they cut rates in June. So we'll continue to watch that as it goes here. So a little bit on the GMI slides. And so GMI is Global Macro Investor, and they build their own models based on the multiple inputs that come in. And economic forecasting is an art, not a science. So you try to use these numbers as much as you can. The white line in this chart is ISM, and the blue line is GMI Financial Conditions Index. And so why this is relevant is where you see kind of the financial conditions look like they're getting a little bit easier in the US. And up until this week, stocks are starting to price that in as well. And ISM, which is starting to tick up here ever so slightly. And just for those who, we've talked about ISM a number of times, but above 50 is effectively expansion, below 50 is contraction, and we're certainly well below 50 at the present time. And so it's interesting to see if we see this number start to tick up, which I believe we are, and financial conditions are getting easier. That's a real positive for taking risk and owning different equities and risk assets from that regard. This again, the white line is ISM, and the blue line is Conference Board CEO confidence. Again, these things are nice when they line up. From the perspective is confidence is low but turning up, ISM is low but turning up. And so this would be just kind of a forward-looking, like what's the next 2-3 quarters potentially look like in the United States, looking to be maybe in this kind of bottoming phase and cycle at this point. And then, of course, this is the ISM again, is the white, and then global M2 deviation from trend. So M2 is just money supply in the system. And so more money supply equals, historically, at least anyways, and I think it'll continue to be the case, more money in the system equals elevated asset prices. And so we look at these again with a forward-looking view where it looks like ISM is picking up. Looks like M2 is picking up, so money supply coming in the system is picking up. If central banks are starting to cut from around the world, certainly that's the case. If quantitative tightening stops, which I believe it will as well, we should have easier financial conditions as well. So these are all kind of forward-looking what is likely to happen. And this is the last one that I like to put up. And so, again, I try to look through the kind of the noise to some extent from a perspective is what's sentiment? Are people bullish? Are they bearish? Are they feeling good? Is this easy or not easy? Tends to be a reasonably good signal for how much downside the market potentially has. So we're seeing about a 5%-ish correction in the market, we'll say, plus or minus. So, when you look at this, and if the market is positioned bullishly and we see a correction, that tends to be something you should be materially concerned about. But as we see this correction into the market right now, generally most investment managers are quite bearish already. And so with that as the backdrop, that tends to give you quite a bit of confidence that, you know, the floor is plus or minus probably a couple percent from here, given what we're presently seeing, and obviously barring anything surprising that we can't anticipate. But assuming from a market perspective, this is a good chart to look at. You know, institutional investors position quite bearishly. We get a bit of a correction. You tend to get quite a significant cover at some point. So I'd be watching for that next year, or next week. That's it for the slides today.
Great. Nice. Keeping it tight.
Yep.
Right to the point. I like it.
Yeah.
Good stuff. Okay. What are we seeing for next week?
Yeah, so I'd be watching to see if there's any follow through with prices lower off of this. But based on the charts, at least I put up today, my view is probably not a lot, if there is any. So I'd be looking, saying, do we pick up from these levels, start to see a bit of a rebound in some of these stocks, or do we continue lower? And so right now, I'll watch it quite closely into the close here. Probably do a bit of buying, actually, as we move into the close, and then see what happens from here. The U.S. Central Bank has a meeting coming up May 1st, which is not next week, but the following week. So we'll be watching for that. But I don't think anything comes out of that one. But that'd be ahead on an economic front. And earnings have started in earnest in the U.S., so we'd be continue to watch earnings as they come out.
Gotcha. And we're creeping towards the tax deadline, which is 11 days, something like that. So I think most people have their tax documents, but not everything is available online. So if you need your gain loss report or your fee report, it's mostly what they can't get online, right? Those are usually the two things.
And foreign property.
Foreign property. That was the other one.
Yeah.
If you need any of those things, please let Ben or myself or even know, and we will get those over to you. Any parting words, Mr. Ben?
I would say the last one is we've been sending out the first quarter reports now. This is something that we've implemented since Eva's joined. It's a first quarter look at what's happened. It's not an annualized number, it's an actual number. So you know, this is how the portfolios had done for the first quarter. So certainly any feedback is appreciated on that. We've had quite a bit positive feedback from clients, but we've rolled this out with the view of keeping you updated on how things are going. And certainly we continue to appreciate your business. And if you need anything, have any questions, let us know.
Amazing. All right, everybody. That's it for us. Have a great weekend. We'll see you next week.
Thanks. Take care.